Welcome back to the channel. This is the Action Figure Grader. This is not a normal video covering vintage Star Wars prices or comic books. So if you are not interested in financial information related to the US economy, by all means, go ahead and skip this video. But I like to cover this every so often. The last time I made one of these videos saying, hey, there's some warning signs in the economy and in the financial markets, very quickly after that video went live, the market dropped about 20%. So I basically timed the market drop perfectly. It was not intentional. It's just, you know, I'm just looking at the information. I'm not trying to toot my own horn here. It's just happened to be what happened. And so I thought it was about time to do another one of these videos because we're kind of at the exact opposite point right now where the market is so foaming and frothing with valuations that it concerns me. And there's enough warning signs out there to at least proceed with caution if you are invested right now. And so I'm going to give you just a general overview of the information I'm looking at. And for a lot of these articles or, you know, data points, I'll include in the video description some links to those in case you want to check them out yourself. And I'm not trying to scare anybody here. I'm fully invested, don't get me wrong, but I am a lot more defensive than I think a lot of people are, for right or wrong. You know, I could end up being wrong on this. So take my words with a grain of salt. But, you know, if you follow my channel, you know that I used to be an investment banker. I used to do this kind of stuff for a living. I'm in real estate, nominally. I'm more or less retired right now, but there's a lot of warning signs out there. So we're going to go through a lot of really useful information. You guys can decide for yourselves as you decide what to do with your money. But this was a really great article that I would highly encourage you to read the whole thing. I picked out some snippets from it that we're going to cover in a second, but on CNBC usually is kind of like mainstream media, and I take what is posted on CNBC with a grain of salt. But this I thought was a particularly good article that does a lot of really nice data points to show you just how crazy valuations are in the tech sector, especially. Obviously, we're in the middle of an AI boom, artificial intelligence, and the valuations are just kind of nuts. And it's pretty crazy when you look at some of these data points that he shares. So make sure to go read the whole article, though, because I think you'll find it to be as interesting as I did. And, again, another website that I really rely on for data is wolfstreet.com. I highly encourage you to sign up for their free newsletter that goes right to your inbox. And, in general, other than the real estate market, Wolf Street is basically, they have some good articles that really show the strength of the household, of the average U.S. household is relatively strong despite what the mainstream media shows. But, there are some issues that are major that I think will affect the U.S. economy going forward. The biggest one being the government debt. Our government debt levels are just completely insane. And as a result, the US dollar is really devaluing this year, especially. It's really come down as people diversify away from the US dollar. The US dollar is down about 10 or 15% versus a worldwide basket of currencies. And that's by design. It's by design from the current administration and really every administration dating back for as long as I can remember, since 1970, whatever it was, 1971 or 72, when we went off the gold standard. The US dollar continues to be devalued in different rates over time. Obviously, we had a big inflation period during the Biden administration. And please, let's not get political in the comments. I'm just giving you the facts. There was high inflation during that time period, and I would argue that by design, the current administration is trying to devalue the U.S. dollar to make us more competitive worldwide in terms of trade. Obviously, the tariffs are also affecting the U.S. dollar. So there's a lot going on there from a government perspective that our fiscal house is not in order. And by devaluing the US dollar, we're using cheaper dollars to pay off old debts. And that's really what's going on there. The housing market, Redfin just came out with this article that should scare you if you're trying to sell a house right now. If you're trying to buy a house right now, prices in some markets have really adjusted down a lot. Florida and California, elsewhere, the prices are way down. But if you look at the U.S. housing market as a whole, there are nearly 500,000 more sellers than buyers right now. Look at this delta, and it's the biggest delta that has, in 31 of the 50 metro markets, it's buyers markets, and there are 34% more sellers in the market than buyers. At no other point in records dating back to 2013 have sellers outnumbered buyers this much. So I don't expect this to change anytime soon. I mean, everyone's talking about how the Fed is probably going to start cutting rates here soon based on the rather tepid employment numbers that came out here recently. But because of what I just mentioned, the fact that the U.S. government is trying to basically inflate away our U.S. debt by devaluing the dollar, bondholders are not going to be willing to hold long-term bonds without some sort of return. And I honestly think it's going to be a repeat of what happened last September. The Fed cut the target rate by 100 basis points over 4 different cuts. And the long term of the bonds and the mortgage rates, the 10-year and 30-year, they went up by 100 basis points despite the Fed cutting by 100 basis points. Because the bond market's saying, sorry, I don't really care whether you're cutting or not. We don't trust you to get your fiscal house in order, and we demand a higher rate of return in order to take the risk of holding these long-term bonds from the U.S. government. So I honestly think it's going to be a repeat of that, and we're going to see either flat mortgage rates or higher mortgage rates. I could be wrong, but as a result, the U.S. Housing market is in gridlock right now. We've covered this in the past. Sellers are not willing to come down on price. Buyers are not willing to pay these inflated prices because mortgage rates are much higher than they used to be. Although from a historical perspective, they're in line with market. Historical norms are in that 6 to 9% for mortgage rates. But because we've had a whole generation of home buyers enjoying zero interest rate policy, or ZIRP, from the Fed with artificially low mortgage rates, there's a whole generation of home buyers that don't want to move because they've got such artificially low mortgage rates. So it's a real problem in the housing market, and I'm not really sure how you fix it other than by prices coming down even further. My wife and I were looking at houses and condos in Florida to get like a vacation or beach house. And the prices in Florida, it's just mind-blowing how much the prices have come down just in the last year. We kind of do it every 6 months or so and kick around the idea of buying a vacation house. Florida home prices they've dropped like 25 to 40% depending on the market. It's unbelievable how much they've dropped. But the problem is you can't get insurance. So my wife and I, we do what we do every time. We say, prices are lower, but we got to spend 15 grand a year to get insurance because of hurricanes and everything else. So we never end up buying anything. We just kind of look casually. Maybe if prices continue to drop, which I think they're going to in those markets, maybe it happens one day, but not right now. The Fear and Greed Index is another one I really like to look at, and it's kind of been all over the place. We've had, obviously, when the prices dropped out of the floor in the stock market in kind of April timeframe during the whole tariff blow up, that was a good time to buy not only Bitcoin but everything. I mean, I really invested heavily in that March-April timeframe, and it ended up being the right decision because the market had a V-shaped recovery. It's already back to all-time highs, but where we currently sit is kind of where I feel, this chart I kind of feel is where the stock market is, if not even worse than what the Bitcoin index is showing. Right now, they're showing greed at 69 out of 100. I would argue that the current stock market is between that 75 and 100 band. solidly in the green, where it's really in heavy greed right now. So the Bitcoin's actually kind of lower than that right now. So, again, take this data with a grain of salt, but here are some snippets from that first article that I just showed you. And this is mind-blowing. Johnson & Johnson, which is a brand we all know, consumer staple brand, and Palantir Technologies, which is, a tech-heavy not startup, but a tech stock that is almost like a meme stock. It's just, the valuation is crazy. They're now roughly valued the same market value. And Palantir is actually valued more than Johnson & Johnson right now, $420 billion versus $440 billion respectively. But the difference is Johnson & Johnson's $420 billion valuation is backed by $93 billion in revenue and expected $26 billion in net income. So that's pure profit, after-tax profit, or pre-tax profit. Not to mention a 200-year-old brand and 3% dividend yield, right? So if you buy Johnson & Johnson today, you're getting a 3% dividend yield, an automatic 3% return on your investment. Plus, it's backed by $26 billion in net income, right? So that's pretty wild. And it is one of only 2 AAA rated balance sheets left in the market. It's really hard to find a AAA rated balance sheet. But the difference is it's only growing at 4% a year. It's a consumer staple. Now look at Palantir. Palantir is at a $440 billion valuation, but they've only got $4.1 billion in revenue. So you're basically being valued at 100 times their revenue number and $1.6 billion in net income. So they're basically being valued at 100 times revenue and 400 times-ish their net income. It's unbelievable how crazy that is. Now, obviously, it's growing leaps and bounds, and it's being valued as such. But which do you want to invest in right now? Would you rather invest in Palantir and bet that they're going to, meet these expectations of growing revenue by 100x and their net income by, let's call it whatever, 300x? Or would you invest right now in Johnson & Johnson, where they are giving you an automatic 3% return on your money through a dividend, and their valuation is maybe a little bit more reasonable? So I'm not saying that you should invest in Johnson & Johnson over Palantir, but it's a lot safer investment, right? And, maybe you need a home run type of hit on that. I don't. To me, I would rather have a lot more of my money in a Johnson & Johnson versus a Palantir. Now, if you want to get growth, some growth, then invest in a growth ETF where your risk is being spread across all of these names in AI and in tech versus plowing all of it, 10 grand, into Palantir or whatever your number is. So that's what I do. Okay. If I want to have exposure to growth, which I have significant exposure to these growth stocks and AI and that kind of thing, I would rather invest in a well-balanced ETF, exchange traded fund, where it's a basket of all of these companies versus one particular company. But it happens over and over again. And at some point, one of these tech companies is going to blow up and never recover. All right. Tesla's already seen that to a certain extent. Maybe it recovers. But if you had all your money in Tesla at the beginning of this year, you're not doing very well. Right. It's down like 40% or whatever the number is. So this is the other thing, is that the market is top heavy right now. Right. And it's always been top heavy, but it's particularly top heavy right now. 6 companies are 1/3 of the S&P 500's total value right now. The top 10 are around 40% of the S&P 500's value right now. It's winner take most index for most winners in the economy. And the other thing is, the S&P 500 is a laggard in terms of returns for a lot of these tech companies. these tech companies, they have their huge run up in value, and they prove to be a winner in AI or in tech of whatever it is. And then after they've already established themselves, that's when they join the S&P 500. So that's the other thing, is that if you want to get exposure to tech, get a growth tech, get an ETF that's focused on growth, because by the time they get to the S&P 500, they're already established because they're one of the top 500 companies, right? It's just something to be aware of, that when you're buying the S&P 500, you're buying a very top-heavy index already. And so there's better ways to have a broader approach than even the S&P 500. Is buying the S&P 500 a safe bet? Yes. You can probably beat most money managers on Wall Street by just buying the S&P 500. But just be aware that you're buying an index that is really top heavy right now. So where do you put your money? I don't know. The other thing that's happening right now is that companies that have a lot of free cash flow, like Nvidia, like Microsoft, like Meta, they're plowing all of that money into AI. And is AI really going to be the savior for mankind? Or is it going to be, Skynet has become self-aware and it all blows up in our face? I don't know. But if you look at the free cash flow right now at the right-hand portion of this chart for Nvidia, for Microsoft, and for Meta, you can see how it's going dramatically down. That's because they're taking all of their cash right now, plowing it back into AI right now. And whether that really pays off remains to be seen. Microsoft, obviously, and Nvidia and all those guys, they're doing really well right now. They have blowout earnings, but those earnings are getting plowed back in, and it's just unsure how that return on investment is going to be. The other thing is consumer staples as a percentage weight in the S&P 500. It's at all-time lows right now, all-time lows. So now might not be a terrible time to invest in consumer staples because they're being really undervalued right now relative to the rest of the market. This chart goes back all the way to 1990. So we're talking 35 years of data. And look at it. As a percentage of the S&P 500, consumer staples like Johnson & Johnson that I just showed you, it used to be around, let's call that 11 to 12% of the S&P 500. And obviously during the tech boom, it slowly dropped until we had the blow up in the internet bubble that was in around March of 2000. I was in it. I used to be an investment banker around this time. And we were taking companies public that had no business being public. And then everything blew up and everyone said, wow, the internet bubble is a bubble. We need to get out of it. And obviously the NASDAQ dropped. Did you know that it took about 12 years after the internet bust of early 2000? It took 12 years for the NASDAQ to get back to the valuation that it was before the internet bubble blew up in March of 2000. So you could have invested after everything blew up in the NASDAQ, and it would have taken you 12 years to get back to even. So it's not without precedent that this AI boom that we're having right now could do it again. There's been booms and busts since the tulip mania of 1929. It happens every time. History repeats itself in financial markets. And I'm not saying it's going to happen, but I'm saying it could, right? And you can see here how consumer staples went right back up as a percentage of the S&P 500 because people got defensive with their money. And after the internet the internet bubble blew up in 2000, and it went all the way back up to about 12% over a relatively short time frame, and then it went up even further, right? It went up even further to let's call that 14% during a recession. During recessions, people get very defensive with their investments. They want safe investments, and more on that in a little while when we look at gold. But as of right now, we've been on a steady decline after the recession, the Great Recession in 08, 09, we've been on a steep decline in terms of consumer staples as a percentage of the S&P 500. What does that mean? That means that the market is really, really top heavy on tech stocks. We're now down to historic lows for the last 35 years. And my argument is that you need to have some consumer staples, some defensive stocks in your portfolio right now, because there is heavy risk based on this data that we're going to have a blow up at some point. It could be another 5 years. It could never happen. I don't know. But from my perspective, it makes a lot of sense to have at least a portion of your portfolio in consumer staples and defensive stocks versus having it all in tech. I feel like a lot of investors right now, especially young investors who did not go through the 08 Great Recession, or certainly not the the internet recession of 2000. Obviously, most of these investors nowadays that are invested in Palantir and Nvidia, they weren't around during the 1990s recession. Well, these are all real recessions that happen, and we had a mini recession here, during COVID, and you can see what it did during COVID. There was a big spike up there, but obviously it was so short that people went right back into tech stocks. So just be aware that we're at a very, very a really real dangerous time period. Another chart that they had in this is that value stocks we're not as deep as in a trough as 1999, but value stocks have really come back down in valuation. With 100 being the baseline, we're at all-time low in terms of valuations for value stocks. Value stocks are another kind of safe option, right? Dividend paying stocks that, Coca-Cola's of the world, right? That pay a really healthy dividend. They're really safe, stable companies that grow just small amounts each year, and they're cash flow machines. They're cash cows. So you can see how low from a valuation perspective, value versus growth, that we're at near all-time lows. It's not nearly as bad as like this, the consumer staple sector, but the value stocks are getting there. And to me, value stocks, value funds, value ETFs, and consumer staples, those are probably the best way to at least have a portion of it in your portfolio. And so I wanted to at least show you some ideas for that. So a lot of these are stuff that's in my portfolio right now. If you want to have some growth, SCHG is, there's plenty of different growth ETFs, but SCHG is a good one that I have. If you want to have a broad market ETF, something that's even bigger than the S&P 500, right? We just talked about how the S&P 500 is top heavy, where the top 6 companies make up 40% of the S&P 500. Well, you can invest in a larger portfolio of companies by investing in SCHB. That's 2,500 companies, 2,500 different companies instead of the S&P 500, which is only 500, right? So that's another one. SCHV is a value fund. We just talked about how consumer staples and value funds are historically undervalued right now relative to the rest of the market and tech and things like that. SCHV is a value fund. There's plenty of good value funds out there. So again, I'm not saying you got to put it all in there, but if you want to just get in the S&P 500, VOO is the ticker for that one. Obviously, I'm pretty invested, though, still in tech. Microsoft is one of my largest holdings. The JP Morgan is a really safe company. Amazon is another one I'm really heavily invested in. So there's options out there. Dividend stocks, I listed a bunch here on the right-hand side. You can screenshot it if you like. A lot of these are ones that are in my portfolio or I'm watching because I'm considering it. A lot of these throw off yield on a quarterly or even monthly basis, and I just take that yield each month and invest it into more shares. Dividend reinvestment plan, DRIP. So they're very, very safe investments. They're not going to blow your socks off in terms of returns, but in a market where it's really, really frothy and valuations are really high right now, it makes a lot of sense to have something in a relatively safe, safe portion of your portfolio. Yeah, a lot of people talk about gold. I'm not a huge gold guy, but you can see what gold has done because of what we just talked about with the US dollar and how the US dollar is being devalued. In the last 6 months, it's just on a massive tear, going from roughly 2,900 to 3,500. That's a huge return, 15 or 20%. And year to date, we've got it's even more year to date. I mean, year to date we're up 35%, and I would argue that gold is really, really a high valuation right now. If you look at the all-time chart, look at the all-time chart for gold, and we've had significant periods where gold has just been relatively flat, right? From 82 to about 2000 ish. It's basically flat. That's a long time where you're not going to get any return on your money. But it's a store of value, right? That's the idea, is that it's a store of value. And then somewhere along the way, the U.S. dollar broke and our debt levels broke, and people started to realize how broken the U.S. government is in terms of how they spend without taking in enough to pay for their spending. And that's when the gold really took off. And there's rumors that China is stacking gold right now, and all these other countries are stacking gold because the US dollar is in a real problematic state right now. No one wants to invest in it. So I would just say, if you are a gold guy, just be careful, because we're at all-time high valuations. And another option, if you happen to be into precious metals, I'm not saying I am, because I'm not. I've got a small amount of gold, but not a lot. But one option is to look at silver instead. And the way to look at silver, in my opinion, is to look at the gold to silver ratio. How much silver does it take to buy one gold? And a typical range, band for that has been in the 50, anywhere in the 50 to 80 band. So 50 silver, 50 to 80 silver equals one gold, right? And right now we're well above that. We're kind of in that 85 range. And, typically if it gets above 80, it means that gold's overvalued and silver's undervalued. And it's a good time to buy silver. If it gets below kind of that 50 band, then it's a good time to buy gold and a bad time to buy silver. So whether that continues on its upward trajectory, which it's been on a steady upward trajectory since about February of 2011, it's just gone nothing but up. It's had some moments here and there where it's come back down, but that's another play right now. If you are into precious metals, is to look at silver, because it's relatively undervalued versus gold. So I don't know if I really had a whole point to this video other than just to say, be really careful, consider some of these, defensive stances with consumer staples or with value funds, at least for a portion of your portfolio, because there are some warning signs in the U.S. economy, namely in housing, namely in the employment numbers, that makes me think that, we're on a kind of on a dicey tilt where it could go either way. So I hope you enjoyed this video. Make sure to check out some of the links in the video description, and I hope they're of help to you. Thanks if you stuck around this long, and I'll be back soon.